Hello, everyone, and thank you for joining us for our latest financial webcast presented by Legend Financial Advisors. Today's webcast is titled, Are We in a Recession or Heading into a Recession? With a Q&A with Jim Holtzman. My name's Dan, the moderator for the webcast. Today's webcast presenter is Jim Holtzman, CFP, CEO, President, and Wealth Advisor of Legend Financial Advisors. Please hold as I turn it over to Jim.
Okay, thank you everybody for joining us today. So the first part of the webcast, I'm going to go over just some updates and some of the main information that we usually cover, and then we'll dive into the main topics for the webcast. I estimate it'll go about 35 minutes or so in terms of the presentation, then I'll take the questions and answers. So this first slide is our volatility index that we typically follow for the S&P 500. And the way you want to look at this is that the red line follows the volatility index, which is typically known as the VIX, and the blue line is for the S&P 500. And so this goes back to the end of 2019 and goes through pretty current through September 5th of this year. So the main takeaways on this is that typically, generally speaking, whenever volatility increases, the stock market tends to not do as well, and vice versa. When volatility decreases, the stock market tends to do better. So since our last webcast a couple of months ago, you can see that we actually went through a period right here around the beginning of June or so, where volatility started to drop off very nicely. We actually got down to at one point just a little bit under 20. And that was really good because as you kind of move across the screen, you can see that we did get below 20 back in March, and then you have to go all the way back to right at the end of 2021. So we haven't had many periods where volatility went that low. Volatility on average for the S&P 500 as measured by the VIX historically has been around 18 to 20. So you can see for the most part, we have been above that range over these last couple of years, maybe not surprisingly, except for really a decent part of last year where volatility stayed pretty low. But the main takeaway, of course, is where we are today. So in this recent decrease in volatility, we actually had a pretty nice market rally. And if you just simply take the peak here, and we'll just draw the line straight up, you can see that the stock market then went on a pretty nice rally, pretty much coinciding with where the trough in volatility or the low point was. And my line won't be exactly straight down, but you can see that it does follow pretty closely still, and that has been historically the case. And so while it's hard to use this as a timing mechanism for making investment decisions, it does allow us to confirm what is happening in the market. And if the volatility index or the VIX starts to really spike, you know that there's probably going to be some negative volatility as far as the market goes. So most importantly then, right now, is you can see that volatility has started to go down a little bit. And sure enough, it's not reflected yet here with the S&P chart, but last week we did have overall a pretty good end to the week in the stock market. So volatility started to trend down. The markets did start to run up, and we'll see how this week plays out. Maybe most importantly from there, looking backwards, is that back in the COVID downturn right here around February and March of 2020, this shows the gray bar is the recession that we were in. And then for the VIX, it jumped all the way from, we'll just kind of go to around the February 19th point where the market hit its peak, and it just skyrocketed all the way up to an all-time high, not even close to prior highs of about 84. And then if you look at the blue line for the S&P, you can see that it really dropped significantly. It was about a 37% drop in about 30 days, which was the sharpest drop over 30 days in history. So again, while you can't really use this as a trading mechanism, it is pretty good. It's a pretty good indication confirming what's happening in the markets with volatility. And then when you really start getting volatility starting to spike above 40, that gets to be pretty unprecedented territory, and you have to be really careful. And at those points, they might want to make some changes to the portfolio, just given how unprecedented that would be. So this gives an update. This is going to be through September 2nd for the various market indexes. So, we've got a number of them. I'm not going to go through each one of these. I think the main thing is when you look at the screen, you can see most of the colors are below zero, the black line indicating zero for the year. Maybe it's easier to talk about what is actually positive for the year. So if you look here at this orange line, this is for commodities, and you can see it's still very strong. It has fallen off from its peak, which is around almost the mid 40s. It dropped off down to about, we'll call it about 15%, and then it's been pretty choppy, but overall has been trending upwards, except for the recent about a 1 week period before September 2nd. If we look at the light green, that is for a managed futures index. That has been positive, and that's about 21% right now, positive year to date. So managed futures, without getting too in depth in it, it is a trend following type strategy. Managed futures funds can track, and most of them will track stock futures, bonds, agriculture commodities, interest rates, currencies, just to name a few. And so if those trends are pretty clear, whether they're positive or negative, that's how managed futures will tend to do better. And in this market, well, the trends have been pretty clear this year. The stock market has been down, bonds have been down, interest rates have been up, commodities have been positive. Currencies have been a mixed bag, although the US dollar is clearly dominated. But the end result is there are a lot of trends that have formed this year, positive and negative, and managed futures has done very well. And you can invest in managed futures through mutual funds, and there are exchange traded funds that allow you to get that type of exposure. However, just like any investment, you have to be careful how the manager is actually allocating the strategy. Now, the dark green line is for the US dollar. So the US dollar has been on a tear. That's always one of the concerns, is the dollar going to fall from its reserve currency status? That's always discussed a lot in these turbulent type times. Well, it is positive right now, about 17%. Now that's against a basket of other currencies, and the reason why the dollar has been on a run is because we've been, meaning the Federal Reserve in the U.S., has been increasing interest rates pretty steadily, and so that makes our dollar more attractive to other countries that maybe haven't started raising interest rates, or maybe are on a slower pace. And then on top of that, the U.S. dollar is still looked at as a safe place to be in times of volatility. So that's basically money flowing into treasuries, and that's how the dollar is increasing. So it's been a pretty historic run. Outside of that, as far as your main indexes, everything is negative. The worst one at this point, the red line, is for the NASDAQ 100. It's still down about 24% approximately year to date. And then if you look at the S&P 500, just to pick a couple of the main indices, you can see right here it's this black line, and that is down, at least as far as even taking this a little more current, it's down about 16%. And then the only other one I'll highlight before moving on is going to be the bond index. So the Barclays Aggregate Bond Index, now this one is a kind of a white color, so it's a little hard to see in the index, but you can clearly see it here. Right now, that bond index is down about 11 to 12%, which is really unusual because usually bonds will offset equities or vice versa, providing some cushion during times of turbulence. What is really unique about this year is that bonds are down at historic levels really at this point year to date, and the stock market is down pretty significantly. So that cushioning effect that normally is there has not been there this year. The only other time in history you can point to that's somewhat similar to this is in the late 40s after World War II, when the government kept interest rates low to help spur on the recovery as World War II ended. And that's really the only other point. That's how unusual this has been. To break it down a little further, this is for U.S. sectors. So the S&P 500 is broken into these sectors. Again, I'm not going to read every one of these to you. The slides are available for you to review this further. I just want to point out a few of the main highlights from this. So the big one would be, well, what is, really as far as the big winners and losers at this point? This orange line represents energy. So probably unsurprisingly, based on what we've seen at the gas pump, for example, right now energy is up about pushing 50%. At one point, it was up here at about almost 70%. Then it had a pretty big fall all the way down to about 30% on a year-to-date basis, and then it's been increasing ever since for the most part, although it has had a decline recently. So very volatile. But that's the only sector in the S&P that's positive, and it's also, I believe, it's still the smallest percentage of the S&P 500. So it doesn't have much of a positive contribution to the S&P 500's performance. Now, the only other one or sector that is positive is this red line, which is for utilities. Right now, about almost 10% as far as its return, a little under 10, high single digits. And you can see even as recently as about a couple of months ago, it was in negative territory, but it is looked at as being more defensive. Electricity has to be paid, so there is a consistency there that stabilizes that part of the market. Once you get beyond that, everything is negative, which does, of course, explain why the S&P 500 is down as much as it is. So just to make one point as far as what's the worst performer this year, it's this white line. And if we go over to our index here, it is communication services. So that's going to be sort of a technology tilt. Companies like Facebook will fall into that category. So though it's not a pretty picture, clearly. Now we'll go to this price to earnings ratio that we call the Shiller price to earnings ratio. I won't get into all the nuances behind the calculation of it, but it's a way to kind of smooth out earnings when you're doing this calculation so that you're not running the calculation at a very high point or at a very low point in the earnings cycle, which can skew your analysis. It averages out over 10 years. The main takeaway is going to be looking kind of historically. So this is basically current, and then it goes all the way back into 1880s or even the 1870s. So if we look at this, this is not the stock market, it's on valuations. So the more expensive, the higher this blue line will be. Well, the ultimate high point is right here back in 2000, probably unsurprisingly during the tech bubble. This valuation measure was the highest. The markets were historically expensive. And then we did have the significant drop in the markets from 2000 to 2002. And as you can see, it improved valuations, kind of falls in line with the markets. And then it starts at the low point in 2002. It was still very expensive, historically speaking. So you can see it was really about the third highest point in history at that time. Then the markets ran up to 07. And then at that, it got to clearly the third highest point in history. Then we had the big fall in the financial crisis. Valuations did become much more normalized, more attractive. And then from that point, from 2010, we'll call it, all the way up to essentially current times, it has been on a pretty high upward trajectory. Now, we have seen a higher peak, which was right before the COVID crisis in 2020, where it reached about 37. So it started really approaching these historic levels. And then, of course, the fallout occurred from COVID, and overall the valuations have dropped only to really be we'll call it the third highest point in history if we call this one the second. So the markets are better priced, but not necessarily extremely attractive or historically attractive. So what that translates into is this chart ties into the last one. It takes that PE ratio, it shows it in 5 different buckets, if you will. When it's been less than 10, that's really attractive. It means the market's really cheap, and this is for the S&P 500. So when that has occurred, the market has delivered a 5-year annualized return of 15.1% and 10-year return of 14.8%. And those are annualized, not just a simple total return calculation. Now, as this number becomes bigger, you will see that the returns drop just because the market is more expensive. Now, these aren't projections. Again, these are actually what has occurred when the market has been at these different valuation measures. So right now, even though we've had a drop off this year, which has made the market overall cheaper, you can see at 32.18, we're still above this last line of greater than 25. And this is what the returns have been. Now, this is before inflation on an annualized basis. So it doesn't mean we're out of the woods yet. So we have to be careful when we're looking at how we have our portfolios allocated. And again, this is for the S&P 500. There are other parts of the markets, including the equity markets, that are cheaper. This is meant to really just give you a broad overview of the S&P. So with that, this is it's a 7-year asset class real return forecast from a company called GMO. And when it says real return, this means after inflation. So this was their last update from June 30th of this year. And so the way you want to look at this, you can see that the projection for U.S. large stocks, which would be the S&P 500, for example, is minus 1%. That's after inflation, and that's on an annualized basis. U.S. small stocks are projected to be negative, and then you do get into positive territory with international large company, small companies, emerging markets, and emerging market value actually has a decent return projection of 7.9% because generally speaking, international investing, whether it's developing or emerging markets are going to be the economies that are emerging, or developing is going to be more like countries like Germany, for example, just to pick one country, that are more developed. They are cheaper, much cheaper than the US. However, our currency has an impact on those returns as well. And with the dollar running up, that has not helped international investing, all things equal, for this year. Now, if you look at the bond market's been just miserable, and the projections really aren't much better at this point. They're better, but they're still not exciting by any stretch. You still have negative returns after inflation, and the inflation amount that is used is 2.2%. So if you were trying to look at the return for U.S. bonds before inflation, you would add 2.2% to this number to basically get to positive territory, at least before inflation, but still almost essentially break even. International bonds, not a pretty picture. Emerging market debt does have the best projected return, but you're dealing with a lot of volatility and a lot of issues surrounding the dollar as it's increasing in value. It's been a tough area. U.S. inflation-linked bonds, not a pretty picture either. You would think that might be the case with inflation running up, but that has not been the case because of how quickly long-term interest rates have actually increased. And that's the projection for going forward. And then cash, U.S. cash is essentially break even, again, after inflation. So the next couple of pages just show some of our watch list of funds that we follow. And I'm not going to be going through each one of these. It's really only to illustrate one thing, and this is for bonds. This is showing the column for year to date. So if you look, everything is red with the exception of this investment, which is just barely break even. And when you go just kind of following down the list, everything is red until you get to these three, which actually have pretty nice returns. But the only reason that's the case is these are funds that short the bond market, meaning expecting the bond market to do well. This has been an historically rough year for the bond market. And if you look up here, this is reflective of different treasury bonds. So treasuries are going to be safe investments. The government does back them, but they don't eliminate volatility. Clearly, that's the case. If you look at a 10 to 20-year treasury bond, and these are ETFs you can buy, it is down 21.6%, which is just horrendous. And then if you look at the 20-plus year treasury bond fund, it's down almost 26. So these are really unprecedented negative returns. And then this fund here, the iShares Core US Aggregate Bond ETF, that's basically the main bond index I referenced before. It is down 11.32%. So I'll leave it at that. There are ways to cushion some of the fall that we're seeing in the traditional bond market. A lot of our portfolios we're using almost exclusively, and we've been doing this all year, floating rate type funds where the interest rate adjusts and that essentially mitigates the risk of rising interest rates, which is why the bond market has just been so terrible. A lot of the floating rate funds that we're using are down between 1 and 2%, maybe a little over 2% this year. So nothing even close to what we're seeing in more of these traditional bond market measures. So the next page is going to show you very similar looking format, except these are for some equities that we follow. And again, I'm not going to spend a lot of time going through these. It's just meant to show how rough the year has been. So if you just look at this year-to-date column, you can see that pretty much everything is red. Now, the areas that are in black at this point, well, you have, for example, a managed future strategy. This particular fund's up 15%. You have palladium, which is a commodity. Down below, you have the commodities index. That's positive. You do have solar, which is actually having a good year. That's a fund that invests into solar companies, so it's actually equity based. Insurance has actually been a good place to be, and we'll cover some of those concepts later on why that's the case. So even though I showed you the indexes, the sectors pretty much mostly being down, there are parts of the equity markets that are actually positive this year. This particular fund shorts the market or shorts stocks, so it is positive, which does make sense. The next page will be a continuation of this one, and this one actually jumps up a little bit bigger on the screen, but you can see the same trend. Everything is negative all the way down to here. Metals and mining has been a good area overall just because of what we've seen in commodities. In this area, these are actually companies, mining stocks that are part of the ETF. But for the most part, you can see it's just been really nowhere to hide, and some of the losses have been very significant. So this is another one that we usually will cover on our webcast, and it just shows you U.S. stock market fluctuations. And so the way you want to read this is going to be taking a look at the different types of declines. So a dip is a 5 to 10% drop, whether that's over 2 months, 3 months, whatever the case is. We usually average about 3 of these a year. During wide periods of time during the 2010s, we weren't even having dips in the market because interest rates were so low. So this average frequency, it's more normal to have this kind of volatility. When it says average length, that means how long is it typically, or it's the average recovery time. So it's only 46 days, not too bad. A correction is 10 to 15% downturn. We average about 1 a year. The recovery time is 115 days. The severe correction, 15 to 20% down, about once every 2 years, and it takes 216 days to recover. A bear market, 20 to 30% high to low, which the S&P has achieved this year. It's been down over 20% at one point, and that's about once every 6.25 years, and it takes 11 months to recover from that. A severe bear market is 30% or more downturn, high to low. The NASDAQ has been in that territory this year. Those occur once every 8.25 years, and it takes almost 2 years to recover. So a couple of main takeaways on this is that you can see the importance of trying to minimize losses in a portfolio over these time frames, because you can see the average frequency as we move down, meaning these losses get to be bigger. They do occur less frequently, and then the problem becomes that when it does happen, the average length of recovery also increases. So another point of note is that with the bear market, severe bear market, even the severe correction, we've been way overdue for this, just because of the lack of volatility we've seen, which in general is a positive for the stock market. So that's where things are right now with the various types of declines. So now we're going to talk about what is the traditional definition of a recession. So when I say traditional, I don't mean official. This will be what you typically would hear mostly if you're listening to the news or reading a financial publication. And that is 2 consecutive quarters of contracting or decreasing real, meaning after inflation, gross domestic product, more commonly referred to as GDP, which is the economy. So when that happens, it's not an official definition, but oftentimes that's referred to as being in a recession. Well, we've had that this year. The first quarter the real GDP decreased at an annual rate of 1.6%. And then in the second quarter, it was down 0.9%. So we did meet that the traditional definition of a recession. But we have been going through some really unusual times. We've had to deal with COVID over the last couple of years. We've had stimulus programs put in place. We're now seeing job growth and wage growth and strong consumer spending in a period of time while interest rates are increasing. We're going to talk a little more about these odd dynamics in a couple of minutes. So then the question might become, well, what is the formal definition of a recession? So there's a group called the National Bureau of Economic Research, more commonly referred to as the acronym of NBER. They determine when the U.S. is in a recession. So they have a committee of 8 economists or 8 members, and their definition of a recession is not as objectively defined as 2 consecutive down quarters of GDP, but and this is a direct quote from their site, it's a significant decline in economic activity that is spread across the economy and that lasts more than a few months. Well, that leaves them a lot of wiggle room to define this. So the problem with this formal definition is that it's determined way after the recession typically is over, often 8 months to 12 months afterwards. So even in '08 and '09, we knew we were in a recession. It wasn't really formally defined, I think, till the end of 2009, maybe the beginning of 2010. So it doesn't do you any good from a predictive or market or investment standpoint. It's just the way it works, and that's when it'll be officially defined as being a recession. Now we're going to talk about short-term interest rates. So there's a confusion in terms, oftentimes, with the way interest rates are defined and what the impact is on the markets and the economy. So the short-term interest rates, you'll hear about this the most. This is when the Federal Reserve meets. They control what's called the federal funds rate, which is a benchmark, which is a short-term interest rate benchmark. So they meet, they decide, are we going to increase rates, are we going to decrease rates, or are we going to leave them alone? Well, the trend has been clearly this year, there's been an increase in interest rates. The most recent bump up was 0.75%, which is a pretty decent sized jump. That's being done in order to lower inflation because it increased the cost of money. If you're borrowing, it'll impact, like, for example, a home equity line of credit typically has a variable rate. Credit cards. Car loans are typically fixed, but if you're trying to get a new car loan, you'll see the higher interest rates being reflected to a degree. On the positive side, if you will, if you have money in a money market, you will see interest rates go up. Maybe not percent for percent with what the Federal Reserve is doing, but you've probably seen at least somewhat of a trend upwards with it. So businesses will pay more for loans because they usually will have adjustable interest rates, and that slows down the economy. And that's really what the Federal Reserve is trying to do. And with some of the inflation numbers that have come out over the last, let's say, 12 months, that's been very alarming. And they haven't really dropped down too much. And so the Federal Reserve has continued to increase interest rates to slow that process down. So let's talk about long-term rates. So the market is really what determines long-term rates. So if there are inflation expectations, what you will see is long-term rates, and I always give the example of mortgage rates, will start to rise because it's reflecting that higher inflation expectation or higher inflation rate. So the Federal Reserve, they don't control long-term rates like they do short-term rates, but they do have some influence on long-term rates. And they do that by either selling or buying treasury bonds and mortgage-backed bonds. For the most part, that's what they deal with. So if they're worried, if they want to have interest rates go up, they'll focus on selling treasury bonds and mortgage-backed bonds. All things equal, that should push interest rates up. If they want to decrease long-term rates, again, think mortgage rates, and they're going to try to have some influence, they are going to buy treasury bonds and mortgage-backed bonds because that additional purchasing will allow the interest rate to come down because there's so much more demand for it. So it's an important distinction because they don't really have that direct control over mortgage rates or 10-year rates or whatever longer term rate you want to pick. So this will show you what the federal funds rate has looked like for really we'll just focus on since it goes back to the late 90s. You can see that before we hit 2000, which again was the tech bubble peak, you will see that interest rates were actually starting to rise before that. That was to put a calming effect or try to tamp down inflation. And then they continued to raise rates during that period, and then it started to level off. And then this is actually right around the time of 9/11. Then they started to decrease interest rates quickly because of the concern of what was going to happen to the markets. And so, all things equal, when the Federal Reserve is decreasing rates, they're trying to stimulate spending. They're trying to even, excuse me, arguably stimulate the stock market. And that's why you see this trend line going down so quickly after 9/11. Then it starts to slow down. We get to around 2004, levels off for a period of time. And then steadily, the Federal Reserve increased interest rates. I think it was 0.25% every meeting, all the way up to here, which is in 2007, right before the financial crisis. There was a leveling off period, and then the financial crisis hit. The peak was October 9th of '07. Things got to be really bad in 2008. And in the fourth quarter of '08, the Federal Reserve essentially dropped interest rates all the way down to zero really, really quickly, as you can see here. Then we had a period of time from, we'll call it 2010, all the way up to 2000 and right before 2016, where they left rates alone at zero for that long of a period of time. That has never happened before. Then they started to slowly bump up interest rates. It leveled off again. And then they started raising rates. I think it was about 0.25% every meeting again until they got to around the fall of 2018 or the fourth quarter of 18. And then the stock market just plunged. It dropped about 20% in the fourth quarter, and that scared the Fed. They slowed things down, didn't do anything, and then they dropped interest rates. And that leads us all the way into the period of time of the COVID crash, where the Fed again dropped interest rates down to zero. We stayed there until they started picking up rates somewhat recently, and now we're back above 2%. And so if you kind of just draw a line across, again, just covering this period for about 20, little over 20 years, you can see where we are kind of historically. We're way above where we've been since basically the financial crisis. And we tied, if you will, where we were in the fourth quarter of 2018. So to kind of think about this again, when you see this line going down, the Fed's trying to stimulate the economy and even arguably stimulate the markets. When it's stabilized, it's a period of really no interest rate changes. When they raise rates, they're trying to temper inflation, and that's where we are today. So that's where the federal funds rate is. It's expected that this will continue to rise next year to maybe around 3.25, 3.75%, maybe have a leveling off period again. But that'll really just be, on a real-time basis what the Federal Reserve thinks is appropriate. And just as we talked about in the very first slide about volatility, when interest rates are falling or staying very stable, that overall is good for the stock market and does help to spur on spending in the economy. When rates go up, doesn't mean the stock market's always going to do poorly, but it usually does lead to more turbulence or volatility because that typically is what happens when interest rates go up. This chart is going to show you mortgage rate trends. So this will show you the current time frame and where interest rates are, and this goes back to last year, about a year ago, when interest rates, were at basically all-time lows again. So we'll just focus on the purple line for now. That's the 30-year mortgage rate. So you can see where we were basically a year ago. We were under 3%, albeit slightly. And then we had a really big spike. And this jump up to this point around June of this year, mortgage rates almost touched 6%. So that is that's basically a doubling of mortgage rates in a 6-month period, 7-month period, which is that's just really dramatic. So that also contributes to why the stock market has been struggling over essentially this period of time. then in June, we did have a nice market rally, and you actually saw long-term interest rates drop off, and they went all the way down to just slightly under 4%. That went through about towards the end of July, beginning of August. And then you've seen 30-year mortgage rates again jump up. Now they're back up to 5.89%. This does coincide pretty closely with the stock market rally at this point when rates dropped. And then we had another rough period over approximately the last month where the markets didn't do well and mortgage rates jumped up. Now the last week has been overall pretty good for the markets, and we'll see where the 30-year mortgage rate tends to go. One other interesting part about with the 30-year mortgage rate is, again, long-term interest rates, the market really determines that. So with inflation expectations over this period being so concerning, that's why the rate jumped up so quickly. This drop-off that occurred, there has been some indications that inflation is going to start trending down. We've seen a little bit of that in the last couple of reports, and the markets usually are a leading indicator, and that's why the markets, you could argue, have been ahead of that. And that's why they started the drop-off as well, spurring on some of the stock market rally that we've seen. But again, it's kind of reversed, and now we're back up almost we are at a current high point. Same kind of trend on the 15-year mortgage. And then 5/1 ARM, that stands for adjustable rate mortgage. That's where the first number, the 5, is where you get a mortgage. It's fixed for 5 years, and then it starts to adjust after that. You can have a 5/1 ARM, 3/1 ARM, 7 and 10/1 ARM, just for example. So with that, let's talk about just some of the impact. We've covered some of that already in terms of increasing interest rates on the economy. It makes sense. It's a decrease in consumer spending just because more money is going to pay interest. Corporate profits drop off. The U.S. deficit will increase. You will see on the positive side increasing rates on bank accounts. And as a result of mortgage rates going up, all things equal, you'll start to see slower home sales. And we've seen all those indications start to happen. All right, so this index, there's the way to read this chart. The first thing is this blue line is what's called the Conference Board of Leading Economic Index or Economic Indicators. And then the gray line is the Conference Board's coincident economic index or indicators. So we were talking, I mentioned before, the stock market is a leading indicator for the economy. So there is a measure with the leading economic indicator that has 10 different measures, and I'll show you those in the next 2 slides just to give you an idea. Those 10 measures are combined to make this index, and one of those 10 is the S&P 500. So the way you want to look at this, and this goes back to 2000, so here's your 2000 to 2002 period. The recession occurred mainly in 2001 and into 2002. Well, the leading index, we'll just call this the leading indicator, the blue line, started to drop off well before the recession occurred. And then it hit its trough or the low point, and we'll call it toward the end of '01, and then it started to rise. And 2002 was an awful year for the stock market. It was a really terrible year for the economy. But this index or this indicator was starting to rise, and you can see it really started to jump up. And the market, it was an indicator of the market starting to have its rebound after the tech bubble had burst. And then as we get to this period, you can see it starts to fall off. And then lo and behold, here's your financial crisis, the recession again in the shaded line, and it just fell like a rock. And so did the market subsequently, and during the same time frame. The market hit a low point in March of '09, and then you can see the leading indicator really from that point all the way up to, we'll call it the COVID crash, was really for the most part rising. And then the markets were rising as well. And then of course you saw the sharp crash, the recession in gray, and then this blue line jumping right back up. So the reason why I'm pointing this out is that the market is a leading indicator. Yes, there's other factors that this index will use, but the economy doesn't follow the markets, or the markets don't follow the economy. The market is a leading indicator ahead of the economy. So it shows signs of dropping. If you look at the economic data at this point in the mid 2000s, it was very good still. Now, there were problems under the surface building, which we did find out, but this was an indication that something was wrong. On the same vein, as we get to this point where we hit a low point and then it started to rise and the markets did start to rise, the economy was awful back in '09. You had banks failing, hundreds of banks failing, job losses were continuing. That started to level out probably right about here, but this blue line is already gone. It's a leading indicator. Then the same thing happened. It's a little more on top of each other just because of how dramatic the drop was because of COVID. But what is interesting then is that you will see the blue line again for the leading indicator just take off like a rocket. But as we know, back in 2020, the market hit its low point on March 23rd. The economy was a mess. We were still in the mandatory shutdown period. Then things started to loosen up a little bit, but it was a mess. The economy was doing terrible, but the market was rising. This is just another way to look at it. The coincident economic index, I'm not going to focus on that one as much. I just trying to get the main emphasis here with this webcast is that the market is a leading indicator, and sometimes it doesn't make sense with what's going on in the markets compared to the economy. So let's look at, these are the 10 components, again, just focusing on the leading economic indicators. So it'll involve looking at average weekly hours worked. So as that increases, that's better. The average number of initial applications for unemployment insurance is factored in. Manufacturing new orders. There's a new orders index, again, related to manufacturing. The volume of new orders for capital goods. I mean, these are all mostly going to be positive things that are factored in as they're rising. The next 5 new building permits for residential buildings. Here's your S&P stock market. What's called the inflation adjusted monetary supply, sometimes referred to as M2, meaning that there's more money being added into the economy, which can ultimately help the economy. They look at the spread between long and short-term rates. So that's another way to be a leading indicator. If spreads are starting to widen, meaning long-term rates are much higher than short-term rates, that can be also an issue. And that's worked into all 10 of these components. And the last one is average consumer expectations for business conditions. So I don't want to muddy the waters up too much. It's just an interesting way that you can actually break down and maybe get some early warning signs or positive signs for the markets. So now the problem right now, or maybe a potential problem, is I'm going to go back 2 slides, is where we are right now. So here we are in 2022. We've had a really nice run up since COVID, but this is still trending downward. So we're going to have to be careful in terms of seeing where the markets go from here. So there's a lot of tugging and pulling with the markets and the economy, and a lot of it can be very confusing, especially in a time frame where we've had a pandemic. So let me jump ahead a couple of slides. So ultimately what the problem becomes is that it feels like the markets and the economy just are completely disconnected. So we've had 0% interest rates for really a long time, as I showed you on the one slide, which is a good thing for the markets. We've had different forms of stimulus put into the markets really since 2000, including '08 and 2020 and a couple of other various points. Those are short-term positives for the economy. So the market has done well, but especially during the period from 2010 to 2020, didn't always feel like the job market necessarily was in line with that. So another way to look at the market being disconnected is by looking at valuations. So it's a way to look at investor psychology. So as valuations continue to get more expensive because the market is running up, what ends up happening is that investors, they kind of want to jump on board. They don't want to miss what may be even a more significant run up. That's not always the case. I mean, oftentimes investors will kind of chase the markets, not realizing that they're actually having a bad entry point at that point. So at the peak of every market, investor greed runs too high. And I give a few examples. We dealt with crypto. We had what were called SPACs, a special acquisition company. Those were another kind of area of investor greed getting to be too high. Meme stocks, those kind of things, they've all completely crashed because the valuations didn't make sense. These were all really true speculation and just a form of what happens typically at the top of every market. So this is a slide we were left on. And so a lot of times at the peak of a market, you'll hear about, well, this time's going to be different. The markets are just going to continue to run. Crypto is going to be great. And this is just going to be a brand new market. Most of the time that doesn't occur that way. And you can go back to the technology stocks in the 90s and at the beginning of 2000 when technology companies were not, a lot of them didn't have earnings. So it was a really troubling time for investors, and they thought this time it's different. The market's going to continue to run. That didn't happen. Same thing happened before the financial crisis with bank stocks and housing stocks, and of course that it didn't end up being different. The markets completely fell apart. COVID, I can't say so much. It was because of such an unusual event, but the markets were extremely expensive. So kind of that this time is different would apply in that case is that the markets are they're going to continue to get more expensive. It's a new era. Earnings are going to keep up with the markets, and that would justify the price. And it just didn't happen. COVID was sort of the pin that pricked that bubble, if you want to call it a bubble. And so that's where we are, today. So when you hear that terminology, this time's different. The markets are going to be okay. It just it rarely works that way. So another way to look at this is that markets can stay higher. Whoops, my screen just jumped. Bear with me one second. Markets can remain very high longer than investors believe will be what we'll say is logical. And another way to think of it is if the markets kind of have an average that it usually will stay around, when the markets are rallying, it'll go above that average, and oftentimes will go way above that average mark, and then it falls. The momentum turns the other direction. Oftentimes the markets will fall much lower than that average. So you have to be careful about that whenever you're making your investment decisions. You want to make sure you're allocating maybe to different parts of the market that are cheaper as opposed to parts of the market like the S&P 500 that have become very expensive at times, along with the NASDAQ. So another way that the market disconnect can happen from the economy is that the more the Federal Reserve supports the economy, and that would be by lowering interest rates, for example, and buying bonds, the market can become overvalued from that just because it creates kind of a euphoria. It seems like the markets are going to just continue to run. Volatility is typically pretty low, but oftentimes that can become a trap. So I give a couple of examples. So we had the example back in 08 and 09. So the stock market actually started to go down in 2007, but the economy was still performing really well. There were signs that the economy wasn't doing well, but sort of under the surface. You weren't really seeing that in the daily data. And then, of course, it was October 9th of 07 is when the big stock market decline started to occur. But there were some early warning signs that this was going to become more of a problem. Then you get to March 9th of 09, which was the low point of the stock market decline. And it was just a mess. Banks, as I had indicated before, were closing, but that was actually your best entry point in the markets for really probably in 20 years, over 20 years, because the market at that point started to have its increase that really lasted until the COVID crash for the most part. Then we go to 2020 for COVID. So the market hit its peak on February 19th. Then the shutdowns started to occur. COVID really was becoming front and center. The economy was starting to do poorly because of that, but the worst was really yet to come. And then that's exactly what happened was then the market hit its low point on March 23rd of 20. The economy continued to shut down. COVID was still getting worse, but the stock market started an historic run. So if you can relive that period and go back to that point, there was a lot of fear in the markets. Consumer sentiment was not good, or investor sentiment was not good because of what was happening. However, again, if you went fully to cash, that became a big problem because the market started to rally, even though the day-to-day news was just absolutely horrendous. And then the other example would be this year. So the market hit its peak on January 3rd of 2022, And actually, the S&P went to bear market territory, so that's a 20% high to low. The Nasdaq reached that severe bear market, which is that 30% high to low. But for the most part, the economy was continuing to chug along. A lot of really good jobs numbers were coming up, and just overall, the economy, for the most part, seemed pretty good still. So now the question becomes: are we at another pivot point? So has the stock market hit the low point already? We don't know, of course, but with signs that the economy is starting to slow down because of increasing interest rates, there is a possibility. So this works. Oftentimes it works in reverse. It doesn't make sense that at the beginning of the year the market started to drop with the economy doing well. Well, now maybe we're at the other point. The market for the first 6 months of the year, or even 7 months of the year, was pricing in the economic downturn that's probably going to be showing up more in the second half of the year. So that's probably where we have been. So where we have been going, maybe the market's going to start to rally, even though the economy is showing more signs of slowing down. Interest rates are going to continue to rise. There's no perfect answer to it, but oftentimes, investors will just kind of hear the news, understandably so, and invest accordingly. But the market's usually past all of that. They've already priced that in, whether it's good news or bad news. So you just have to be really careful with that. This is an interesting chart that shows consumer confidence. So the blue line, the light blue line, is the S&P 500, and the black line is a consumer confidence index. So this runs from '09 until basically now. And so the main takeaways are going to be, as you see, if we go back to, let's just pick on a time frame of 2008, 2009. It really runs from 2009 to present. So you'll see again, the market starts to run up, but investor confidence is at a low point. So again, it's that sort of reverse psychology. Investors are very nervous because of job losses, banks closing. The market was already down so much, but the S&P had started its rise again. So then just kind of fast forwarding it over to now, you can see the S&P has had a pretty good run for the most part since the COVID crisis, excellent run. You will see consumer confidence was at a really low point. And then as the market started to rally, consumer confidence started to become very good. And then we had another sharp drawdown in consumer confidence while the market rise continued. So there's just different ways you can look at this, but it's pretty consistent that oftentimes the markets will rise when consumer confidence is at its lowest point, or that pivot will take place. So what are we doing with our clients' portfolios? So this gives kind of a summary of some of the moves we've made this year because of the way the market has been changing. So earlier in the year, we cut back our exposure to technology. Technology had done so well over the last 5-6 years, it just got to be too much in our client portfolios. So we cut that back. We had to take some gains, and in cases of taxable accounts, taxable gains. But that helped because that's the area of the market that really has done the worst. We bumped up large cap value exposure. And why we did that is that as rates are rising, value investing tends to do better. Growth investing tends to do worse. Technology, for the most part, is growth type investing. So we took from expensive and moved to lower or cheaper or less expensive areas of the market. We were able to take some gains from metals and mining and our commodity exposure, actually, at that time, that had significant run-ups because of the war in Ukraine. We also increased small cap value exposure. So again, value, interest rates going up, that tends to do better. And small cap also tends to do better in that situation. And in our client portfolios, we felt we needed to boost that exposure. We added some more commodity exposure. That was really pretty much at the end of last year and the beginning of this year. We also were carrying more cash than normal heading into this year because of rebalancing, and the market started off so poorly, so we weren't in a rush to invest all money at once. We added managed futures around midway through the year, which has been very good in terms of lowering volatility but increasing returns for our portfolios. And some other moves we've made in our bond area, we reduced some of our floating rate exposure that did so well over these last couple of years, and we added some traditional bonds. So when interest rates hit their peak and really are at a peak again, we added some traditional bonds because when rates go down, bond prices come up. And that's been a dynamic we really haven't had much of over the last 12 years. But we found a good entry point to add traditional bonds to the mix, which again helped offset equity in most normal environments. So we've also been strategic in harvesting some tax losses in parts of our client portfolios. Consumer discretionary has been probably one of the areas we've done it the most in. We added some biotech to our more aggressive portfolios. We've also added an asset allocation fund in some of our lesser aggressive portfolios. And the way this fund operates is it actually hedges part of their portfolio. So they have stocks mostly in that, and some gold in their fund, and then they actually are able to hedge, meaning reduce some of that equity exposure. So we liked adding that to our lesser aggressive portfolios because it gave us overall increased equity exposure in case the rally continued, but we didn't have to add on too much volatility in order to accomplish that. We also just did some kind of normal portfolio management. We had some positions that were underweight, meaning if we targeted 4% for a position, maybe it was down to 2.5%. We boosted those back to its normal position. Small cap was one of those specific areas. And then in our stock portfolios, we've been able to find more companies because of the downturn that we've had has made some stocks to be much less expensive. So it's been a more moves than we typically will make, but they've been strategic, they've been tactical as the market has changed a lot this year. And who knows how the rest of the year will play out, but we do have some other moves we're considering to make. And those are for our less aggressive portfolios, we might add a merger arbitrage strategy to those portfolios. And while that might sound risky, it actually is not. And I'm not going to get into all the details on that for this webcast, but it's something we're considering. This type of strategy does well with rising interest rates. And so it's been a while since we've really been able to use this strategy, and it's coming back onto our radar screen. We might further reduce the floating rate loans. One of the areas that were things I didn't mention before is that with those floating rate loans, while they've been fantastic, they are more subject to the economy, credit risk. They're more aggressive in that respect. And so we have to be very careful of how much we have. So we might reduce that further. We might add some more traditional bonds to our portfolios, especially if interest rates are going to jump up again, like long-term rates, because that's a really good entry point. And then we're also considering increasing our emerging market and or developing market exposure. So this is more international based. We have exposure in our client portfolios that have equities to some degree. And while they're much less expensive, and that sounds like a really good entry point, as the dollar is raising in value, makes it not so good of an entry point, but it's something we're going to watch closely whenever that starts to turn. So next thing we'll cover, and just one more slide, is the 12-month outlook. Just some things we're looking for. We don't know where the markets are going to head, but we are watching closely for signs of a recession. If the Federal Reserve continues increasing interest rates, that becomes a higher likelihood. When will they stop bumping up rates? Well, there's some expectations they might go to 3.25% to 3.75%. That seems pretty reasonable as far as expectations go. And that might be enough to give us a very, maybe a mild recession in that respect. The U.S. growth outlook has decreased for the next 12 months just because of the increase in interest rates, decrease in earnings. So we do have some anticipations of some slowdowns there. We'll be watching for those earnings declines, as that will have an impact on the pricing of the market. I mentioned before about watching the dollar. Is it going to stop? Will it stop increasing? That will probably coincide with the move in short-term interest rates that the Federal Reserve will do, meaning if they continue, the dollar will probably rise in value. If they stop or maybe start to lower rates over the next maybe a year out, then the dollar will probably start to fall off in value. And other countries are increasing their rates, they'll probably pick up the pace a little more, and that could also slow down the price of the dollar. And then another thing to watch for is what's called quantitative tightening. So we've had quantitative easing, which is where the Federal Reserve is helping the markets. But now we're in a period of what's called quantitative tightening. And that's where the Federal Reserve is not purchasing bonds anymore. So when they buy bonds, that all things equal will keep long-term rates lower and help the economy and help the markets. What they're doing now is that they've been buying bonds for such a long period. When those bonds are becoming due, they're not reinvesting them. So all things equal, that is going to be slowing the markets and the economy down. And then also, they're looking to sell some of the bonds as well. So these two things are, negative, if you will, for the short term for the markets and the economy. As this will push longer term interest rates up. It's anybody's guess. The data changes really quickly these days. Some of these spikes we've seen in rates, the supply chain issues, these dynamics are moving quicker than they ever have. And I think that's why, for our portfolios, we've made more changes than we might typically do. And thankfully, they've all really helped at this point in time. But this gives you an idea of what we're thinking about. So with that, I am going to take some questions and answers. So I'll just pause a minute to wait for those to come through. Okay, so a couple of questions have come through. One is about supply chain issues, and they've been improving. So wouldn't inflationary prices decrease? And yes, that would be the case, and that's what we're starting to see some signs of. And where it starts is that those improvements are going to be more on kind of the production side, which doesn't always get as much attention. We're used to our main concern is what happens to our day-to-day spending. So those supply chain issues have had an impact where prices are starting to come down, and we've seen some of that. We've seen the gas pump that's been better. Food, not necessarily so, but some parts of food have been coming down as well. And the pressures have been all things equal decreasing, and some of that certainly is attributable to the supply chain issues being worked out. You don't see boats, the big cargo ships 25 miles sitting out in a line in the ocean waiting to be able to deliver their goods. So things have been improving a lot from where we were, and that's been all things equal a positive, and that's some of the reason why inflation expectations are coming down. I mean, I've seen everything from inflation getting back down to even 3% in the next year. I'm not so sure about that. We spent about 20 years where inflation was between 2% and 2.5%. It's kind of hard to see it getting back down so close to those levels. But that's just it's an estimate, it's a guess. We don't know. But for the most part, most research that we follow it's been pretty consistent that inflationary pressures are starting to come down and will continue to be the case. And a second question has to do with the fiscal irresponsibility looking, or will that seem to be interfering with the positive moves that the Feds can offer? So certainly with deficits, the budget, the debt load of our country being so high, those are problematic, especially with interest rates going up. So all the debt that's been accumulated, especially over the last 20 to 22 years, we've kind of gotten away with it because interest rates have been so low. Now with interest rates going up, that does cause concern in terms of the U.S. government's budget, because if interest rates go up, just like we deal with as a homeowner or a personal consumer, the debt load you have, if it's variable in nature or if you have to keep issuing new debt, is going to be at a higher interest rate and a higher interest rate expense. So that will hurt, certainly, the deficit, all things equal, unless we have some ways to counteract that. So it is a tug of war. And so while the Federal Reserve is trying to stem inflation, they're also causing other issues because they're increasing their short-term rates. The moves they're doing is trying to stem the inflationary effect that we're having. But it's a real tug of war when you look at fiscally and as far as what the government can do and what the Federal Reserve is doing. Excuse me. So another question is the value of the dollar, with the value of the dollar increasing, is that a positive sign? It really depends on what side of the fence you're on. If you are a company that exports, that's going to be a positive sign that the dollar will start to come down. We haven't really seen that yet, but whenever that really starts to happen, that will help in that respect. So that's just one example. Some of the exporting companies have been really struggling with the increasing dollar just because it increases the price of those goods that are going to be purchased. On the same vein, as far as imports coming in, that won't be so helpful just because, again, of the impact of the dollar. So the dollar makes things tricky because of certain parts of our economy will do better, some will do worse. So another question came up just clarifying more on long-term rates and short-term rates. So with the Federal Reserve, they directly influence the short-term rates, like the money market rate, think of it that way, and then they indirectly influence long-term rates, think mortgage rates. The market really dictates where longer-term rates go, and the market doesn't have direct control on the short-term rate. So it's really interesting and really important to watch long-term interest rates and get a feel for what the market's really saying is going to happen, because the market's usually pretty accurate as being a leading indicator with some of those charts and some of the slides that I shared before. And so it is important to follow that, because that was some of our first indications that we probably are going to see some reductions in inflation because of where long-term rates started to drop off. Now, they fell really quickly back in June. We've seen that kind of reverse. So if we start to see those long-term interest rates come back down again, think mortgage rates, that probably will mean that inflation is going to be coming down. It might not be at a quick pace right now, but it would most likely indicate that it is going to start to decrease. So I know a lot of this is it can be tricky, it can be confusing, because some of it doesn't make intuitive sense. And that's why I gave those examples of the disconnect with the markets in the economy. And maybe right now is another one of those points. Maybe the market's gonna, at least I think the market was starting in a positive direction today, which can mean about 1 week's worth of a rally happening. But you're also starting to hear about companies laying off individuals. And certainly earnings have been coming down in certain industries because of the rise in interest rates. That doesn't mean the market can't rally, though, in that situation, because the market may be looking past all of this already. And that's where it gets to be really confusing, where that investor psychology can come into play and sometimes isn't very helpful. So I am going to wait another minute to see if there are any other questions, at this point. But I do realize this could be very, very confusing, and it's a very challenging time. And a lot of the historical data that we talk about can be, you have to throw it out the window because of all the things we've seen over the last couple of years with COVID, supply chain issues, things like that. You can sort of maybe see some parallels using past times, but not directly, just given where we are, at this point. All right, so give it just a few more seconds. And it looks like that's going to be it. So I'm going to turn it back over to Dan to close up the webcast.
Okay, great. Thanks, Jim. That was a lot of great information you provided today. And I want to thank everybody for joining us for the webcast. If you'd like to schedule a conference call with a member of our advisory team, please call our office at 412-635-9210 to set up an appointment. Thank you again for attending, and this concludes the event.